Concerns about inflation are once again front and center as the latest CPI readings in both Canada and the U.S. showing trends moving in an upward direction. Despite any concerns about uncertainty, markets, however, remain on a stable path. So what's actually going on? Hafiz Noordin, Vice President and Director of Active Fixed Income Portfolio Management with TD Asset Management, is here to give us some insight. Nice to have you here. It's been too long, so it's good to have you here in person.
It's great to be back.
Let's just start with maybe, we'll get into inflation in just a second, but whenever I have some of your colleagues in talking about the equity markets, it's like, you couldn't have more going on in the world, and yet they're creeping upwards. Where are the bond markets right now? And when you think about contextually in terms of where they've been?
Right, yeah, it's been, it felt like a lot of noise, a lot of uncertainty, but it's interesting. You look at where we are today, the Canada 10-year bond yield is basically where it was on January 1st. So we're still at 3.2%. And similar story in the US. So it really comes back to this idea that, bigger picture, global growth is doing just fine. Corporate earnings are doing just fine. And economic data has been coming in kind of not too hot, not too cold. And that allows bond market volatility to stay low. And so when you have low bond market volatility, that means that the rest of the markets tend to also behave fairly well. And that's supported equities. Currencies globally are going up versus the US dollar. Credit spreads are staying stable, so meaning corporate default risk is not a concern for investors. So for the most part, yeah, a lot of noise, but we're kind of just, steady as we go here. And
that's why we like having you here, because it's extraordinary when you look again at just what's going on, and then you say, yeah, bond markets are stable.
Right, yeah, and at the end of the day, we feed off of inflation, right? And right. I know that we're worried about, will inflation go up? But right now, inflation is still kind of in this 2 to 3% range. So again, not too hot, not too cold. Even last week in the U.S., CPI was surprised to the upside, but the very next day we saw a weak retail sales print. So it's still this kind of environment where growth is kind of near trend, but not overheating.
When I look at the markets and people I've talked to, I think about all the things that could be stimulative in the States. And I'm going to let you kind of go through where you think the list is. And then I look on the other side to say, well, this could be deflationary, all the cuts that are coming with Doge and stuff. How do you see it netting out?
Yeah, I would say net, what we're seeing out of the Trump administration looks like it will be additive to their fiscal deficit. So it's kind of this pro-growth fiscal policy that, if you get a $4.5 trillion tax cut package like they are proposing right now, and you don't get enough savings on the spending side, then that adds to the economy, that adds to pro-growth and inflation. And so I think that's where, if we are concerned about inflation, it's more on the U.S. because they have this appetite where, even though they have very large debt levels, even though their fiscal deficit is around 6% of GDP, they're willing to ramp that up even more. Mm-hmm. And you're not seeing that as much in the rest of the world, at least right now. We could see that perhaps more in Europe as they think more about defense spending, as they think more about infrastructure, and particularly in Germany. So it's a trend that we may start seeing in the rest of the world, but I think the U.S. is front and center.
So rising inflation could mean forget the rate cuts that we hear that politicians want. It could be rate hikes we're talking about in the States.
Potentially. So this not too hot, not too cold data right now is allowing for the market to still price in 1 to 2 cuts maybe for the rest of the year in the U.S. and here in Canada as well. If we do, though, see CPI data in particular surprising to the upside on a more sustained basis, then those 1 to 2 cuts will get priced out. But I think we have to think about the bar for a rate hike from a political perspective is still fairly high. You have the Trump administration really looking for borrowing costs to stay low to fund all of the initiatives they're thinking about from a growth perspective. So I think politically it'll be hard to hike rates, but inflation data will dominate at some point. I think right now core PCE is the data point that the Fed works off of to set policy. It's at 2.5. If it were to keep, trending higher towards, north of 3%, I think even President Trump will have a hard time pushing back on the idea that the Fed may need a hike later in the year.
What about on this side of the border? Where do you see more divergence? I mean, because the economic fortunes of the two countries look to be diverging at this point.
Well, yes, and that is the dominant narrative between Canada and the U.S., but a lot of that's played out already, right? When you rewind back to, last summer when we started rate cuts here in Canada, and you look to where we are today, the Bank of Canada has cut rates by 200 basis points from its peak policy rate, and the Federal Reserve in the US has cut by 100 basis points. So double the number of rate cuts in Canada because of what you said, because of that diverging growth profile. Canada kind of well below trend growth, but not in a recession, while the US is staying much more resilient in terms of growth and now has this new fiscal policy in play. And so that's kind of played out in terms of, now a policy rate of, around 3% in Canada. And, if you look at where the bond market's priced in, maybe one or two more cuts here as well as in the US. So if we kind of play that out, we'll see a terminal rate in Canada of around 2.5% and in the US around 4%. So that 150 basis point difference between the two policy rates is already kind of priced in to bond yields, and it's kind of fairly high historically. You have to go back to the mid-90s when we had a fairly deep recession here in Canada compared to the US, where we had maybe 200 basis points or so differential in the policy rate. So there is precedence for where we are right now, where growth is stronger in the US versus Canada, but I think that's largely already played out. And so the Bank of Canada from here, I think, really will be looking at what will the Fed do, and also has to pay attention to inflation. Is it going to start to rebound here as well? Today's CPI print that we got was okay on the headline, yeah, but it was a little bit hotter on the core side, 2.7 instead of 2.5. So again, not a red flag, but it's sort of going to start to enter into the minds of the Bank of Canada of thinking, we've done a lot, maybe we just need to kind of pause a little bit here. Unless we do end up getting something on the tariff side.
Which is a tough place for them to be in, right? Because if you actually have a slowing economy and still have some inflation that's maybe getting exported, or it comes, your kind of hands are tied a bit, right?
That's right. I mean, it's you have this big uncertainty around tariffs, but it's a known unknown. So they kind of they probably have that playbook of what to do in that scenario. But for the most part, the fundamentals of Canada are still okay. Growth is still holding up. It's not amazing. But it's not enough of a slowdown to say we have to take policy rates below our neutral rate to an area where we'd be stimulating the economy.
One thing that everyone that I talk to are like, yeah, where's the currency, right? Because that's, you think about how many people in Canada are traveling, working, and all the things that are happening. So where do you see the loonie in the next little while, given what you think is going to happen?
Yeah, we had a big move over the past year in terms of the Canadian dollar depreciating because, again, Bank of Canada cutting a lot more than the Fed. And then on top of that, with the tariff moves or the tariff kind of concerns, we saw a move in the Canadian dollar to around 68 cents. So that's kind of that peak tariff concern on February 3rd. And since then, we've rebounded to a little bit north of 70 cents. I actually think that it could be a little bit more room to appreciate. We could see 71, maybe 72 cents. And the reason is that the Canadian dollar versus US dollar is priced off of really three things. The difference between the two policy rates, oil prices, and broader risk sentiment. So we've talked about already kind of seeing a divergence in the two policy rates. On oil, hard to say right now. It's sort of stuck between its own geopolitical kind of influences. But it's really more, I think, the third one, broader risk sentiment, that if we see it improving because of this idea that maybe tariffs are not going to be long-lasting or just kind of these short-term kind of negotiating tactics to get concessions out of various countries, then that sort of discount in the Canadian dollar could start to get removed. So I think 71 to 72 is reasonable, but I don't see a very strong rebound back to 74 or 75 when we have this really wide gap in the two policy rates.